Aditya Narain is ready. Good morning. Let's connect with him. Aditya, I don't know how to start, because when you see a market bouncing 40% from the recent lows, when everybody was on the same side of the boat, and I'm not surprised why everybody was on the same side of the boat, because there is bad news all around. So there is bad news all around. Big market gurus globally and locally have been advising caution, yet markets are going higher as if there is no tomorrow. What is causing this kind of a comeback?
So I think it's a bunch of things. I think if you were to look at it in a historical context, whether it was the GFC, whether it was the Great Depression, I think even as you've got into these problems, after the early round of corrections, you've actually always seen a reasonably sharp bounce back. So I think to some extent, history has supported the fact that even when the immediate outlook is poor, if stocks have reacted enough, then they tend to come back very substantially. So I think that's one bit. I think the other thing that has actually happened is that, fundamentally there has been a lot of money that has been pushed into the system globally, right? And what typically tends to happen is that that money is going to be at the end of the day either going to markets or it's going to go to credit. And in the initial jump, I think what inevitably happens is that it tends to go to markets. And that's what you're tending to see at this point in time, that all the liquidity that's been pumped in is largely finding its way in some form or the other into the markets. I think the issue is, when does it start going into the credit markets, right? Because that's what is fundamentally required. And once that starts happening, it's actually better for the economy from a longer term perspective. But that potentially will start cooling off what is lying there from a pure, headline equity market level. I think the third thing that has happened in this particular case is that the market, after having seen, supply completely stop, is now following supply as it opens up. And I think what you're seeing at the moment is, someone moving up to 50% production levels, some moving to 70%. You're seeing people on the streets, you're seeing airlines beginning to take off. And I think people are tending to follow that. So I think it's this combination of the fact that historically it's always happened, the fact that there is money in the system, and the fact that people are looking at supply, which is obviously tending to look much better than what one was viewing a month ago.
Aditya, everyone's saying, oh gosh, it's liquidity. It is cheap money, low interest rate, and that's the reason why markets are going higher. Now, Aditya, we know low liquidity, high liquidity and low interest rates are here. They are here for next 2, 3, 4, even 5 years. So then what is the end game? I mean, keep on buying stocks because interest rates will remain low for long and liquidity is abundant?
So I'd say two parts. As I just mentioned, I think in the initial phase of liquidity, it goes into markets. The second stage, which is what it is intended for, effectively goes into the economy, right? And unless you get this balance, unless money cannot sustainably stay only in the markets and not move into the economy, if it doesn't move into the economy, by sheer lack of performance of the economy, those markets will come down. As long as money starts moving in it at a reasonable pace into the economy, and the economy responds the way you want it to or the way you hope it will, I think that is what tends to provide a certain amount of support to the markets. So the end game really is that you must end up having economic activity, which is initially spurred by the fact that money comes in through an external element to support this shift. And I think that transition is very, very important. If you have a situation where markets stay very strong for 2, 3, 4 months, and you don't have money going into the real economy, which, mind you, is the scenario in India at this point in time, given that loan growth has come off a little bit. If you have that mix, then markets will inevitably retrace, right? I think the other way of also looking at it is that when you have an event of this magnitude, right, then you need structural changes that effectively happen both in spending, in thinking, and how they operate kind of patterns. And this happens for the government, this happens for businesses, and this happens for individuals. And quite honestly, I think at this point in time, the way that corporate India is tending to restructure itself, I think what can be seen as a little bit of a given is that businesses are going to get much, much sharper. The lead businesses, that is the ones who either are already advantaged or change themselves very dramatically. I think businesses will be in much, much better shape over the next couple of years. And I think the market is beginning to pay a little bit for that, right? I think what happens with the government in terms of its books, in terms of its economic policies, I think also going to be fundamental in terms of how it moves over the longer term. And likewise, what happens with the individual? I think quite honestly, one can make a little bit of a call that savings rates in India are actually going to start going up a little bit. I think the challenge will really be in terms of how does spending moderate or how does it change. And if you have a situation where that is impacted very significantly, that could end up being a challenge. So I think this strain of how segments of the economy change, government, businesses, and individuals, I think that will make a meaningful difference in terms of what the medium term to longer term outlook for equities is.
So, how long do you think public markets and economy will remain disconnected? I buy an argument that the first flush of liquidity has moved into assets and asset prices have gone higher. But there would be some point at which if the economy does not pick up or does not heal, for whatever may be the reason, you will start questioning the underlying valuations. Are we there yet? Do you think markets could remain patient or patience will run out soon?
No, so we are not there yet. Okay, as I mentioned initially, I think a lot of the focus has been on the supply side, and as it eases out, there's a feel-good factor to it. I think demand is what is going to determine where markets stay or where they move, right? And quite honestly, the real year to look at demand, I think, is FY22. And for us, all our multiples now are based on FY22 for the reason that we see that as a normalized year post this event, right? So that's one bit. I think the second bit is that I think the second half of the year, led by Diwali, in my view, right, is going to be when you're going to get a first dipstick of demand, right? And I think that is where you're going to have a certain amount of adjustment that happens to markets. It could be on either side. If you have demand coming back very substantially, there will be a much better feel good about the whole thing. If it does not, then it's going to be a reset a little lower. But I think Diwali is when you've got to get a sense of demand, which is what the market eventually has to play for. It has played for supply so far, the pace of opening up, the availability of money, right? And of course, the fact that people are getting out on the streets now. But demand is what is going to be the final measure. And as I said, the next couple of months, and why I say the next couple of months will not tell you where we are, because that's a cyclical element. There's a certain amount of pent-up demand. There's still a carryover in terms of what the impact of these 3 months have been. But it's Diwali onwards, October, November onwards, when there is an event that you have the first measure, which is when I think you start taking a more real call on stocks and valuations, and in terms of businesses that will do well and how the economy itself will fare.
Okay, so as of now, no major changes. Then, Aditya, I'm guessing still overweight pharma, tech, defensives. Would you still say that's the best strategy to go with?
Yeah, at this point in time, yes. We've argued that, in the life cycle of a market, when you have a crisis like this, there is a kind of a capitulation stage, which we saw about 2 months back, where the market comes off very sharply and then moves up a certain amount. Then there is a consolidation stage, where the market tends to move around that a certain kind of mean as it tries to figure out how the economy is moving and what is the nature of dislocation, right? And then there is a kind of a revaluation kind of stage where if there is a sense the economy is going to do well, the markets start moving up on a more sustainable basis. Our view is that at this point in time, we're still very much in that consolidation phase. We've had about 2 months of it. We think there's another 3 to 5 months of that space when the markets are fundamentally just going to move up and down around the mean, and which is where we are at this point in time. So quite honestly, at this point in time, particularly because we are probably at the higher end of that consolidation phase, we would very much remain defensive with some of the sectors that you mentioned.
What are you making of all the action in telecom between all of the investments into Jio, of course, but also buzz, whether it's around Bharti, whether it's around Vodafone, and yes, Bharti's clarified on those reports about talks with with Amazon, but nonetheless, the space does seem to be heating up.
Yeah, see, I think it's really a reflection of a couple of things, right? The first is that there's been, this pandemic has moved economies generally decisively towards technology and towards telecom. So I think that's the underlying of it, right? The second is that you actually ended up with a market through whatever has become a very consolidated market. So you basically have just three players. And so the action is really going to lie in revaluing those three players for the most structural opportunity. And the third bit is that capital is making that call that guys, this is the backbone. Here there is a structural change. The industry structure is fundamentally favorable, and that's why capital is effectively chasing these three very limited assets that you have. So I think it is just the sector took a lot of pain for many years, but it has culminated in a situation where you've got a consolidated bunch of businesses running it, structural change in terms of demand, and fundamentally at this point in time, the market chasing the bigger boys, providing them more capital to actually strengthen themselves. So it's a combination of that, but the underlying fact is that it's a consolidated market, and equally important, I think it is a tectonic change for tech as it's happened now, in terms of usage patterns, in terms of dependence, and in terms of literally, data being the new oil kind of conversation. It's showing itself up. It's shown itself up over the last 3 months, and I think this will only accelerate from here. The industry structure is fundamentally favorable.
Tactically, Aditya, are you worried about the peak valuations that the market is ascribing to select group of stocks? One can say that about, say, some in the telecom names. FMCG, definitely, selectively, you are seeing peak valuations there as well. Or do you think that is not a concern because, these are businesses that are going to do well for multi-decades, perhaps, and, they're going to definitely not be derated. They may be devalued and stay put at the same levels for some time to come, perhaps.
Yeah. So I'd say two things on that, right? The first is that this is not an Indian trend, by the way. This is a very global trend. In fact, if you look at India today, about 1/3 of market capitalization lies with 10 stocks, right? But this is very true in the US. It is true in other emerging markets. So it might not be a third of market cap, but it varies anywhere from a quarter to about 35%. So this concentration in a few businesses and a few of the largest businesses is actually a global phenomenon. We might be just running a little ahead of everybody. So I think that's one bit. I think the second bit is, as you argued, is this, you start looking at these as businesses from a 10-year perspective and from a longer term perspective. In part, I think the market will do that. But effectively, the risk that that lies with being very concentrated in this space is of underperformance rather than absolute negative performance, right? That you might have a situation where if economic recovery is a little broader and a little better than what is being extrapolated at this point in time, these stocks stay here for a period of time which could well extend into years, right? So the risks will lie not so much in them falling off, because there is reevaluation of their business prospects or the quality of these companies. But the risk lies in terms of underperformance if the economy starts doing a little better than its consensus at this point in time. What you have to remember is that this concentration in a few businesses and a few companies tends to work when there is a lot of uncertainty. The challenge with this is that too much dependence on a few companies limits the kind of growth that you're going to end up eventually at the broader economic level, because you need many, many more companies of a certain level of value to drive this growth, right? So what you're seeing at this point in time is risk aversion, but this is not great for growth. At the end of the day, the broader economy has to do well for growth to feed on itself. And this is, as I said, a reflection of the fact that people are fundamentally cautious, but also the fact that these companies are set for a longer period of time, and it's a global phenomenon.
Fair point, Aditya. Great to have you on the show. Thank you so much for taking the time out and speaking with us today.